Today we're going to unpack why Asia-Pacific is now the engine of the global energy transition, and what the next 5 years really look like behind the headlines. Between 2025 and 2030, China is expected to add roughly 1.39 terawatts of new renewables, while the rest of Asia-Pacific, excluding China, adds another approximately 670 gigawatts. That means this region alone will account for the majority of global renewable capacity growth, even as the market shifts from breakneck expansion to a more mature, infrastructure-constrained phase. In this video, we'll break the story into 20 short chapters, from China's consolidation and India's rise, to ASEAN's new regional plan, offshore wind, grid bottlenecks, and the storage boom, so you can see where the opportunities and risks really are. Let's start with the big picture for 2026 to 2030. The IEA and other analysts now expect Asia-Pacific's clean energy capacity to nearly double over the next 5 years, with Asia taking close to half of global solar PV market share by around 2026. China remains the giant, but India, Southeast Asia, and Northeast Asia together are where a lot of the incremental growth and policy experimentation will come from. At the same time, power demand in Asia-Pacific is set to surge by about 790 terawatt-hours in 2026 alone, with this region accounting for around 85% of global demand growth, driven heavily by data centers and AI loads. So the key question isn't just, how much renewable capacity can we build anymore? It's, can grids, storage, and policies keep up with this structural demand shock? Let's go to China, because any Asia story starts there. For the first time in about a decade, analysts expect China's annual solar and wind additions to decline in 2026 to around 318 gigawatts of new solar plus wind, versus almost 500 gigawatts built across the whole region in 2025. The China Photovoltaic Industry Association sees 180 to 240 gigawatts of solar PV alone in 2026, with average annual additions of roughly 238 to 287 gigawatts through 2030. BloombergNEF has a similar view, about 321 gigawatts of solar in 2026, down around 14% from 2025. But put that in context. China's so-called slowdown is still more capacity added in 1 year than any other region on Earth. What's driving this cooling in China? A big factor is policy number 136, which shifts projects away from guaranteed feed-in tariffs towards more merchant, spot price exposure. That forces developers to think harder about grid connection quality, power prices, and curtailment risk, instead of just chasing volume. On the supply side, China's solar manufacturing sector is going through a painful consolidation. Leading PV manufacturers posted multi-billion-dollar losses in 2025, and polysilicon producers have agreed to cut output by roughly a third to rebalance the market. There's even a coordinated push to retire outdated factories and bring total module equivalent capacity down towards approximately 780 gigawatts, which should stabilize prices over the next few years. So for investors and buyers, 2026 marks a shift from infinite cheap supply to a slightly more rational, but still highly competitive, Chinese equipment market. Even with this adjustment, China is hitting some historic milestones. In 2026, solar power capacity is expected to overtake coal capacity for the first time, a symbolic turning point for the world's largest power system. China is on track to achieve its 2035 wind and solar targets 5 years early, and will still represent close to 60% of global renewable capacity additions through 2030. On top of that, analysts expect a rapid scale-up of green hydrogen, with China beginning large-scale domestic deployment and starting to develop export capabilities. At the same time, China's data center power demand is forecast to more than triple from around 20 gigawatts in 2024 to roughly 63 gigawatts by 2035. Adding more baseload demand onto the system. All of this means China's challenge is no longer just build more renewables. It's integrate them into a system that's being transformed by AI, hydrogen, and electrification at the same time. Next, India, arguably the most exciting growth story after China. BloombergNEF expects India to overtake the United States as the world's second largest solar market in 2026, adding over 50 gigawatts of solar, versus an expected U.S. decline to around 44 gigawatts. India recently saw record auction activity, with over 60 gigawatts of utility-scale renewables tendered in a single year, about half of that in hybrid solar-wind storage formats. The IEA projects India could add close to 345 gigawatts of renewable capacity between 2025 and 2030, more than tripling its 2022 base. If grid and distribution company issues are managed, India is on track to meet, or even exceed its 500 gigawatt renewable target for 2030. But 2026 for India is not just about volume, it's about quality. Analysts describe 2026 as a quality over quantity year. Tendering has deliberately slowed, so that regulators can catch up on transmission congestion and execution risk. New tenders increasingly require storage and flexibility, pushing more solar plus storage and hybrid projects instead of standalone PV. Hydropower and particularly pump storage are projected to triple by 2030, creating more flexibility for a very peaky demand profile. So if China is moving from phase 1 to phase 2 of its transition, India is right at the inflection point between phase 1 scale and phase 2 system integration and reliability. No, let's shift to ASEAN, where 2026 is the first year under a new regional energy blueprint. In late 2025, ASEAN energy ministers endorsed the ASEAN Plan of Action for Energy Cooperation 2026-2030, known as a PAC, along with a long-term renewable roadmap. The plan sets aspirational 2030 targets of 30% renewable energy in total primary energy supply, 45% renewables in installed power capacity, and a 40% reduction in energy intensity compared with 2005. These targets are backed by 7 program areas, including the ASEAN Power Grid, renewables, energy efficiency, and transboundary projects. It's ambitious for a region where clean energy investment is still only around 2% of global totals. But the political signal is clear. ASEAN wants to move from pilot projects to system-level integration. Within ASEAN, Vietnam is a crucial test case. After a chaotic solar and wind boom, Vietnam has now embedded renewables into its revised National Power Plan, PDP-8, with targets of roughly 73 gigawatts of solar, 6 gigawatts of offshore wind, up to 16.3 gigawatts of energy storage. By 2030, policy work is underway on direct power purchase agreements, allowing large consumers like factories and data centers to contract renewable power directly from generators. Combined with electricity law reforms, this is shifting Vietnam from a one-off boom cycle to a more predictable, integrated investment environment. How effectively Vietnam executes on storage and grid reinforcement will heavily influence whether it can keep attracting international capital at scale. The Philippines is emerging as ASEAN's offshore wind laboratory. The government has launched its first major offshore wind auction, known as J5, targeting about 3.3 gigawatts of capacity for delivery between 2028 and 2030. Philippine regulators have set a benchmark tariff of roughly PHP 11 per kilowatt hour for these offshore projects, and are opening the door to tariff indexation to manage cost risks. Developers have already secured grid connection agreements for around 1.65 gigawatts of offshore wind, a critical step in actually getting projects built. With technical potential estimated at more than 68 gigawatts of offshore wind, the Philippines could become a regional hub if it can sort out permitting, transmission, and offtake structures. This is one of the most interesting markets to watch for investors looking at early-stage offshore wind in emerging Asia. Indonesia is another heavyweight in Southeast Asia's transition. The latest long-term power plan, Renewable 2025-2034, increases room for solar and other renewables, and for the first time starts to address coal-phase city-out pathways, alongside battery storage, and even nuclear options. Analysts highlight Indonesia, Vietnam, and the Philippines as the 3 countries that will drive most of ASEAN's incremental clean power demand and emissions reductions. Targets for Indonesia include double-digit gigawatts of solar by 2030 and a gradual decline in new coal capacity in favor of renewables and transmission upgrades. But high financing costs and regulatory uncertainty still slow project execution, which is why international partnerships in concessional finance are so critical here. One of the most transformative but underreported stories is the ASEAN Power Grid. So far, 8 of 18 priority interconnections have been completed, enabling cross-border power exchanges between several ASEAN members. Under the new enhanced APG Memorandum of Understanding, which the Philippines is championing as ASEAN chair in 2026, The goal is to move from bilateral deals to multilateral power trade and wider renewable integration. Studies suggest that modernizing and interconnecting ASEAN's grids could unlock around $25 billion in economic value by 2030 through better utilization of low-cost renewables and reduced curtailment. This cross-border infrastructure will be the backbone if the region is serious about reaching its opaque renewable targets. Within ASEAN, Singapore is following a very different playbook: import-tiled decarbonization. Domestically, Singapore aims to deploy about 3 gigawatt peak of solar by 2030. But land constraints cap how far it can go on its own. The Energy Market Authority's strategy is to import up to 6 gigawatts of low-carbon electricity by 2035. And it has already granted conditional approvals for more than 8 gigawatts of potential imports. The headline project here is the Power Link, also known as Sun Cable, a 4,300-kilometer HVDC submarine cable planned to bring solar power from northern Australia into Singapore. Singapore is also importing power from Laos through the LTMS-APIP multilateral project, effectively piloting the ASEAN power grid concept in real life. So Singapore becomes a test case for whether a highly urbanized city-state can buy its way to decarbonization through regional integration. Moving to Japan, the transition story is more complex. On the renewable side, Japan has passed legislation to open up its exclusive economic zone for floating offshore wind, effective April 2026, with an industry vision of around 15 gigawatts of floating nights capacity by 2040. At the same time, the government is leaning back into nuclear power and has cut subsidies for large-scale solar, raising concerns that fossil fuel and nuclear interests may slow down the renewable build-out. Japan has launched a $20 billion hydrogen contracts for difference program, the largest in the world. But green hydrogen and ammonia co-firing are still significantly more expensive than LNG through at least 2026. A really interesting twist is that data centers and AI loads are now reversing Japan's long-term decline in electricity demand, creating new pressure on the system. So Japan is juggling offshore wind, nuclear restarts, hydrogen bets, and rising digital loads all at the same time. South Korea is also pivoting hard towards offshore wind and storage. In early 2026, the government released a new energy transition plan targeting about 100 gigawatts of renewable capacity by 2030. A key instrument is the Special Act on Offshore Wind, effective March 2026, which creates government-led planned development zones and is expected to have permitting times from around 71 months down to roughly 31 months. South Korea's offshore wind target is about 14.3 gigawatts by 2030, but only 0.2 gigawatts are operating today, just 1% of the goal. On flexibility, Korea aims for around 2.22 gigawatts of energy storage by 2029 and is leveraging its domestic battery giants to supply LFP-based ES systems. Regulators are also overhauling the renewable portfolio standard, moving to capacity-based targets and more bankable, long-term contracts for new projects. So 2026 is a reset year for Korea's policy framework. None of this works without energy storage. Across Asia-Pacific, installed energy storage capacity was about 85 gigawatts in 2024, with China accounting for roughly 88% of that. China alone is targeting 180 gigawatts of storage by 2027, more than doubling current levels in just a few years. Vietnam is aiming for up to 16.3 gigawatts of storage by 2030, South Korea for over 2 gigawatts by 2029, and Malaysia has launched its first 400 megawatt storage auction. The Asia-Pacific battery energy storage market is estimated at around $7.3 billion in 2026, representing roughly two-thirds of global demand, helped by battery pack costs, dropping about 45% over the past 5 years. The big gap is still market design. In many countries, storage economics rely on government tenders because wholesale markets don't yet reward flexibility properly. Arguably, the biggest bottleneck for Asia-Pacific's transition is not generation. It's grid infrastructure. Regional and multilateral studies warn of a global transmission investment shortfall of around $320 billion by 2030, with Asia-Pacific particularly exposed due to rapid demand growth. Lead times for critical grid components, like large transformers and switchgear, are now running between 2 and 4 years, while heavy-duty gas turbines have moved out to 5 to 8 years. S&P Global and others describe grids as the weakest link in the 2026 power system, especially in Southeast Asia, where underinvestment collides with rising renewables and data center demand. For ASEAN specifically, grid modernization and regional interconnection could unlock about $25 billion in economic value by 2030, but will require significant capital and local manufacturing of key equipment. So if you want to understand project risk in this decade, don't just look at megawatt announcements. Look at transmission build-out. One structural shift that ties all of this together is the rise of corporate power purchase agreements and the data center demand shock. Wood Mackenzie's analysis shows that in parts of China, wind-to-battery hybrids can now deliver power at about one-third of the local utility tariff. While in Japan and Taiwan, some corporate renewable deals are around 30% cheaper than grid power. That price advantage, combined with corporate decarbonization targets, is pushing a wave of PPAs across China, Southeast Asia, and Northeast Asia. At the same time, data centers and AI loads are driving power demand growth in markets like China, India, Japan, and Singapore, contributing to that 790 terawatt-hour demand increase forecast. 2026 alone in Asia Pacific. This combination, surging flexible demand and cheaper renewables under long-term contracts, is redefining who really drives the transition, not just utilities and governments, but also tech and DDoS, industrial giants. Beyond mainstream solar and onshore wind, several emerging technologies are gaining momentum in Asia Pacific. Offshore wind capacity in the region could reach roughly 162 gigawatts by 2030. With about 122 gigawatts of new additions led by China, but supported by Taiwan, Japan, South Korea, and the Philippines. Floating solar is expected to account for around 10% of Southeast Asia's total solar capacity by 2030, with major projects in the Philippines, Indonesia, and Thailand. On the fuel side, the APAC Green Hydrogen Alliance is focusing initially on Australia, Indonesia, Japan, Singapore, and South Korea, while Malaysia's Sarawak is positioning itself as a green hydrogen hub and is hosting a regional hydrogen conference in 2026. Even tidal energy is on the radar. The global market could grow from around $1.2 billion to $8.6 billion by 2033, with Asia Pacific as the fastest growing region at roughly 22% CAGR, and South Korea already leading with over 500 megawatts of tidal capacity installed. These technologies won't dominate capacity numbers in the 2020s, but they will shape niche opportunities and long-term diversification. Let's close with the big picture to 2030. What could go right and what could go wrong? On the upside, if current policies are implemented, Asia Pacific will remain the core driver of global clean energy investment, which already reached about $729 billion in developing Asia in 2023, up more than 900% since 2013. China's consolidation could stabilize equipment prices. India could cement its position as a solar superpower, and ASEAN could finally scale up regional power trade under the PPAs, an enhanced ASEAN power grid. On the risk side, grid bottlenecks, financing gaps in Southeast Asia, manufacturing overcapacity in China, and geopolitical shocks, all the way from trade wars to Middle East conflicts, could slow, distort the transition. And most importantly, even with record renewable additions, some scenarios still point to a 2.6 degrees Celsius warming pathway, because demand growth from electrification and AI is so strong. So the story of Asia Pacific renewables from now to 2030 is not simply more megawatts. It's a race between deployment and system constraints. And that's exactly what we'll be tracking on this channel.